It is a wild day of intraday reversals for the markets after we seemingly get a bit of a reprieve from the White House on the latest worry for financial markets about U.S. fiscal policy, but troubles ultimately persist as recession risk resurfaces. I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We're going to unpick all of it here and see what this price action suggests, and with that knowledge, what we might surmise about where things are going. So we'll start here with a look at the price action, and as ever, be rooted in that, because of course, why guess what the markets are doing when you can let them show you? So here is the S&P 500 here. This is the active futures contract, and you can see here the day started on a clearly positive note. There was a gap higher for the index here at the futures session open overnight. And that was after U.S. President Donald Trump clarified in an interview that he has no intention of firing Fed Chair Jerome Powell, or trying to fire him, before Powell's term ends, or essentially outside of the normal process for how a Fed chair is nominated, seated, and then ultimately when that term ends. That, of course, is very encouraging for the markets. They were very concerned about the possibility that the White House would attempt to circumvent the independence of the central bank, which would, in essence, mark a threat to the entire architecture of the global financial system, U.S.-centric as it is after the 1973 untethering of the dollar from gold and sort of the birth of modern finance with that action. The level of consternation in undoing 50 years of that architecture by forcing or attempting to force subordination from monetary policy directly to the executive would, of course, amount to all kinds of chaos in the markets just on uncertainty grounds alone. And the markets clearly unclenched when the president clarified this was not the intent, even as he posted on his Truth Social platform earlier in the week that Powell's, quote, termination can't come soon enough. So, a positive lead with that clarification, and we end up rallying significantly, almost all the way back to 5,500 on the S&P. But as we can see here, into the close of the day, we erase more than 80% of that move. So we spike higher. We almost certainly get some additional support from comments out of Treasury Secretary Scott Bessent, who continues to signal that a deal between the U.S. and China on trade is inevitable because the status quo, as it currently exists now, is untenable. You essentially have an effective bilateral embargo at both ends of the most important supply chain for the global economy, the U.S.-China link that connects the number one and the number two largest economies in the world. And now they've ratcheted up tariffs on each other to such an extent that there is effectively no trade that's possible. Obviously, these types of things don't take hold overnight. There's a ton of orders that are still working their way through. Inventories need to get worked down, order books cleared out, but the trajectory here is to an almost complete stoppage unless some sort of deal is struck. And the Treasury Secretary seemingly signaling that there is, in fact, that realization at the White House, and that some sort of deal must get reached and some sort of accommodation found. That, of course, helping to animate the animal spirits here, as it were, as well. But we don't sustain it. We don't hold it. We keep the gap, but the rest of the gains, for the most part, fall away by the close. And it's a similar story for the bond market. We've talked at length, of course, about the bond market having been animated by uncertainty risk, that the way that you end up with this massive bond market sell-off in April, despite the fact that stocks are going down, is because everything altogether that's US dollar denominated has come under pressure this month. The dollar's been falling, bonds have been falling, US stock markets have been falling, and that the way to understand this is surging term premium in US Treasury yields. Because what that speaks to is the markets demanding greater compensation for duration risk. And basically saying what might happen over the, in this case, 10-year period, if you're looking at the 10-year note, or 30-year period, if you're looking at the 30-year bond, is so uncertain relative to where it was before that we're going to need to be compensated for that uncertainty in making loans to such an extent that this term premium has become the highest share of overall yields since May 2021. For reference, that's when the Fed last has a major head change and starts to embrace the idea that it needs to go on a major hiking cycle, and puts to bed this idea that inflation coming out of the COVID pandemic was transitory. So, clearly, in undoing some of that uncertainty risk by essentially securing the Fed chair's job, the president is able to have a bit of positive impact on reducing that catalyst for bond market weakness, and so bonds pop. They have a similar gap to stocks. The long bond here even manages to rally all the way back to retest levels last seen in late March. But again, it doesn't hold. And the reversals in both stocks and bonds intraday, interestingly, happen at exactly the same time. And it's when the latest batch of S&P Global PMI data hits the tape and comes back with, frankly, shocking results. The numbers, in particular for the headline, much worse than expected, and showing that the U.S. economy produced the second worst month of economic performance in a year and the weakest pace of overall expansion in 16 months. Now, the most sort of eye-catching part of this is, of course, that the slide in the composite reading here, which captures the manufacturing and the service sector, or the manufacturing and the service sector combined, but of course scaled, not equal weighted. Let's be clear. The service sector is a much bigger part of the overall economy than is manufacturing. That this is now dramatically close to what would be neutral or standstill. We end up coming down to 51.2 on the composite index, and as ever, the PMIs are thought about in a context where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above growth, or above 50, the faster the growth. The further you go below 50, the faster the contraction. And the drop on this composite to 51.2, what that speaks to is increasing proximity of hitting that 50 level, where essentially growth stops in terms of what this indicator implies. And if we look at sort of the history here, the last time that we hit anything like this level was in November of 2023, December 2023. That's the last time we saw lows sort of adjacent to what we're looking at here. That's right there. So all of last year's performance here effectively erased. And of course, that the composite index follows services in lockstep while manufacturing seems to be doing its own thing. That speaks to how important the service sector is here. It also speaks to just how damaging the verdict is on the source of this weakness. Most U.S. imports are of goods, and that the service sector is showing this level of consternation suggests that it isn't so much about the direct impact of tariffs or trade policy that we're starting to see. In fact, where that is more pertinent on the manufacturing side, you actually see things a little bit perkier since late last year going into the beginning of this year. We have basically standstill there, but that's an improvement over contraction in recent months here. And that's because people are ostensibly trying to front run the tariffs and trying to build up inventories and get as much done before the tariffs really start to bite. So we have in the services side something much more ominous. The idea that businesses are so uncertain by the atmospherics, never mind the direct effects on them specifically. They are so unnerved by the tone of what's occurring and the fog with which policy is now appearing that they're pulling back on outlays, pulling back on economic activity, and this is starting to pressure the overall economy. The reason this is so ominous, of course, is because it does not give much room for improvement, even if the tariffs were canceled tomorrow, because that would sustain exactly the kind of policy volatility that creates the vibe that has service providers spooked. And of course, the critical issue here is that the one thing in the global economic architecture that at this juncture cannot afford to hit a wall is the U.S. service sector. We've mentioned at length before that the global economy is primarily powered by three growth engines: the U.S., the Eurozone, and China. Together, they account for 58% of global GDP. This, in fact, understates their influence, because the rest of the world, the 42% that's not those three economies, for the most part are vendors to those three economies and depend on them to generate demand. Well, since the beginning of last year, we've seen an increasingly acute divergence here, and it really starts to be very, very obvious in May and onward. Here we have the composite PMI for the U.S. We have it also for the Eurozone, and we have the S&P global version of it for China. That one hasn't been updated for April yet. That comes next week. So that's a forecast. But the trajectory clearly is unmistakable here. While the U.S. holds firm, both the Eurozone and China are slowing as of the middle of last year and are converging on standstill. China has done a little bit better in the second half of last year, marginally, than the Eurozone, because it did not slip under 50 and go into a recessionary-like dynamic. Europe did. But the direction of travel is clear. The U.S., in the meantime, is holding up firm and is essentially the only pillar that the global growth story has to stand on until the start of this year. The peak is December. As of January, things are already going the wrong way, and the U.S. is converging on the weakness elsewhere. And that is because the U.S. service sector, so we can see the driver of this number here and this curve, we can clearly see that here, because that starts to hit the skids. Just saw an update of global growth expectations from the International Monetary Fund earlier this week, and the most important thing here is to look not even at the projections, but at the direction of revision of this forecast relative to what the IMF released in January and relative to what they released in October last year. These are, of course, very important points. October is before the U.S. election, and January is just as the implementation starts, and ostensibly just as the new administration has prepared to take office. So this is now an updated set of projections reflecting what's happened to fiscal policy in the U.S. And the important takeaway here is almost everything except Spain has a negative sign in front of it. Now, of course, Spain is not a large enough economy to carry the whole globe on its shoulders. So the upshot here is that world output expectations have been significantly reduced for advanced economies and emerging economies in almost equal measure. Some of the biggest revisions, as a matter of fact, hitting the United States and China. So as we look then at the environment, it looks like there's a global recession that is gathering. That perhaps explains how you end up with this response today. It is when the PMI data comes out that you get this retreat back on stocks, because indeed, this is what they've been afraid of all along. If they were afraid of tariffs as a concept, they would have sold off in November when the election was decided, because that part of the platform was very well telegraphed, at least, again, in concept. They didn't start to switch into this ultra bearish mode that we see here until mid to late February, when it's the PMIs that showed that things were starting to deteriorate as a consequence. That was this right here. And this data started to come out. And that was February the 21st is when you start to see it. So as sort of would be appropriate for a market that's concerned less with tone and more with oncoming recession, you get PMI data like this today that makes that recession appear in sharper relief, and whatever sentiment-based gains you had before, they fall away. What of the bond market, though? Why is it following suit? Well, I'd expect that with this kind of state of affairs, the Fed would be likelier to cut, which should imply that interest rates are meant to be going lower now that the administration has stopped appearing as though it's going to attempt to remove Powell from his post before the time. Then we perhaps have given the Fed room to cut more. Now they can do so without looking like they're kowtowing to the executive, which would, of course, threaten the Fed's credibility and thereby neuter it of the essence of its power. So perhaps the bond market in this context is off sides. Well, there is some evidence to that extent. U.S. economic data is increasingly underperforming relative to forecasts, according to this data from Citigroup. So the Fed ostensibly has the economic backdrop to switch to employment support from inflation fighting. The Atlanta Fed GDP Now model confirms as much. We can see that since February, again, mid to late, right here, we have the economic data that goes into this model, that informs this model, become increasingly negative. Never mind if you actually think that it's right about the economy shrinking at an annualized rate of 2 to 3% in the first quarter. We won't know, and it's too early to tell, and it's ultimately not that important at this juncture. What's important is that this is a nowcast updated with every new piece of major data that might impact the model, and all of the data that's come into it since basically 2 months ago has fed a steep decline. And that, of course, tells you what kind of data it has been, what this data flow has felt like. So the ingredients pointing to a severe economic downturn. They're all ostensibly here. But as we can see, the outlook for Fed policy hasn't really moved all that much recently. The market is a little bit more urgent in its pricing than Fed officials would have it. We can see they're baking in 75 basis points for this year and are allowing for the possibility of one cut and some chance of a second one next year. But altogether, we end up with 109 basis points in cumulative cuts between now and the end of 2026, which doesn't veer too far from the Fed's own outlook, but has a little bit more urgency. This is the last update of the summary of economic projections for the Fed. And we can see that they're looking for 50 basis points in cuts this year, from 4.4 average down to 3.9, and another 50 basis points down to 3.4 for next year. So a cumulative 100 basis points. And the markets are only at 109, so not very far, and in fact, pretty well anchored. It's just the Fed sees a 50-50 sort of deployment here, 50 basis points now, 50 basis points next year. The market thinks 3 cuts this year because the situation is more urgent, and 1 next year, again, with a little bit of extra optionality. So we're looking at a Fed outlook that, despite all this negativity in the data, isn't really complying with building a more dovish story. Where it had that more dovish story, it was around these more crisis-like factors that gave us this strange performance in the bond since the beginning, and spoke to those sovereign dollar exodus or U.S. asset exodus that we discussed earlier. And perhaps the explanation here is why the bond ends up where it does today, why it retreats alongside stocks rather than baking in more Fed rate cuts into a recession as a consequence of this data. Here are the price components embedded in the PMI numbers, and here we have them for input and output, services and manufacturing, and we can certainly see what seems to be the issue. But for input costs on the services side, inflation accelerated across the board. It accelerated in services output prices. It is, of course, exceedingly elevated in manufacturing costs on the input side and on the output side, because that's where the tariffs hit directly, both in actuality and in their anticipated effect. Aside from input prices for services, everything else is pointing toward the kind of situation where the Fed would not be as cavalier about cutting because it's concerned about inflation. And that sort of makes for a conundrum here, where on the one hand, stocks don't like the growth scare. On the other hand, the bonds don't like the inflation scare. In fact, if you look at the Fed funds curve here, you can see that there is not a rate cut in sight for the entire first half of the year here. You don't really get to seeing these cuts in earnest until the second half. And so we have a situation not only that seems to lack conviction to build in more easing despite the economic hardship, but it's not too far off from where we were in March and in January, despite the economics of the situation having grown worse. And in fairness, the Fed probably has the clearance to cut, at least as far as the markets are concerned. We can see inflation expectations in the bond markets have in fact been falling, not rising, because it seems the markets have already decided that they know that the tariff regime will be bad for growth, and that ultimately the net result will be disinflationary because the growth hit will overpower whatever one-off price rise that essentially a sales tax on imports would engineer. They're already looking to what that will do to demand and growth and the destructive power for the second order effect. But the Fed probably needs a peg to hang its hat on here. And until it does, we might have more consternation in the stock market as growth concerns persist. But relief in the bond market seems like it will need a sign that the Fed is in fact coming to the rescue on a faster time frame. So far, that appears elusive. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.